Hi guys, it's SJ speaking, and in today's video, we're going to see about financial ratio analysis. So, this is one of the fundamental analysis video. This is important for long-term investors or positional traders or who hold the stocks for around 3 to 6 months. So, monthly trading. For short-term traders or intraday traders, fundamental analysis is not that much needed. They can rely only based upon technical. They can rely technical analysis is enough for them. So for mid to long term traders, fundamental analysis is important, and there are two types of fundamental analysis. One is qualitative analysis and another is quantitative analysis. So this ratio analysis belongs to the quantitative category. Before going into that, what is qualitative analysis? Qualitative analysis means in my EIC video I would have explained that is what is there are several types of analysis such as economy, industry and company. So only take the company based upon the company analysis. If we analyze what the products that the company provides, what service that the company provides in case of a service-based company, whether that product would be the future in the market, whether the market that company will provide products that will boom in the market in the future, or analyzing the market share, how much market share the company has compared to its competitors. So, what is the business model? What is the quality of the management? Analyzing these factors are known as qualitative analysis. But reading the financial statements of the company provides results. It publishes results on the quarterly basis. In India, the quarterly results are the first quarter is April, June, July. Second quarter is August, September, October, and the third quarter is April, May, June is first quarter. July, August, September is second quarter. October, November, December is third quarter. January, February, March is fourth quarter. So the earnings are published 1 month after the 1 month after it. So if the first quarter ends at April, May, June, then the quarterly results are published on July. So it takes place like that. So in the quarterly results, the financials, various financial statements are released, and ratio analysis is one of them. So there are various ratio analysis. So this belongs to the quantitative analysis category. So types, what is a financial ratio? The definition is simple. It is used to calculate a company's financial status and also used to compare with the other similar companies. We should not analyze the individual company alone. We must also compare it to the other companies in the same industry. For example, if we are analyzing the private bank sector, if you want to buy the ICC bank stocks, you must also compare the ratio with the other companies such as Axis Bank or IndusInd Bank or Kotak Mahindra Bank or HDFC Bank, and see whether the ICICI Bank is in par with the other companies or it's better than the other companies. So you can buy that company stock. So this belongs to the category of quantitative analysis. So what are the types? There are many types such as liquidity ratios, efficiency or activity ratios, leverage or solvency ratios, profitability ratios, market value ratios. So what is liquidity ratio? So liquidity ratio is used to measure the ability of the company to pay off its short-term liabilities. It can determine how quickly a company can convert its assets and use them for paying the dues that arise. So higher the ratio, the easier the ability to clear the debts and avoid defaulting on payments. So what it does, it measures the company to pay off its, the company might borrowed money in short term. So it has to return that those money to the respective to the respective creditors. It has to sell. So it has to give them back the money, repay the money. So this liquidity ratios measures how effectively the company repays its short-term debts. So it should convert its current assets and it should pay the liabilities, short-term liabilities. This what this ratio shows, how quickly the company converts its assets and use them for paying the dues. So this must be higher. As the ratio is higher, then easier is for the company to pay the debts and avoid defaulting on payments. So types, there are three types. There are many types actually. I brought only the important ones. So that is why I have given many types. So first one is current ratio. It is also known as working capital ratio. And second is quick ratio, or it is also known as acid test ratio. And the third is cash ratio or cash asset ratio. So then coming to the leverage or solvency ratios. So these are used to measure the company's ability to pay off the long-term liabilities. Liquidity ratios means short-term liabilities. Leverage ratios means long-term liabilities. So the company might have issued bonds and borrowed money from bondholder by providing bonds. So it has to pay interest. So measuring how well the company is able to pay its interest to the bondholders, or it might have bought loan from banks. So how well the company repays the loan along with the interest to the banks. So this leverage ratio gives you an idea. So these ratios can be used by investors for buying the company stocks, or it is used by creditors to give debt, whether I can give money to this, lend money to this company. So these are used by various creditors or investors. So this also determines how much of the capital is present in the company, which is in the form of debts and equity. So the company might issue shares and raise capital, or it might issue bonds and raise capital. So it shows how much the company has in the form of debt or equity. So these are also known as gearing ratios. So types, there are two types: capital structure and coverage ratios. Capital structure determines what kind of capital the company is used for funding its operations. So the company might have bought from shareholders, raised equity capital from shareholders, or raised debt capital from creditors, various outside lenders. So how much it has in the form of debt, how much is in the form of equity. So this capital structure ratio gives you a clarification. There are three types. There are many types actually, but I have brought you the important ones: equity ratio, debt to equity ratio. Then comes the coverage ratio. It measures the ability of the company to pay off its debt obligations, such as interest payments or dividend payments. Interest payments have to be paid to the bond holders, whereas in the case of dividend payments, it has to be paid to the shareholders. There are many types. I have brought the important ones. So interest coverage and debt service coverage ratio. And then comes the efficiency ratios, which is also known as activity ratios or turnover ratios. So these measure the efficiency of the company in utilizing its assets to generate sales and revenue. It measures how well the company used their assets for generating sales and revenue. So types: asset turnover ratio, inventory or stock turnover ratio, accounts receivable turnover ratio, which is also known as debtors turnover ratio, or accounts payable turnover ratio, which is also known as creditors turnover ratio, or days inventory outstanding, days sales outstanding, days payable outstanding ratios, and then bank efficiency ratios. So next comes the profitability ratios. This shows how well the company is able to make profits by using various assets from its operations. So how well the company generates profits by using its assets. So the money which we give, so company uses them as assets and it makes some profits. So these ratios show how well the company is able to make profits. So there are two types: margin and return ratios. So margin ratios measure the company's ability to turn the sales into profits. Suppose take two companies, company A and B. If company A has sold as sales revenue, has generated revenue of around 1 crore rupees, and company B has also generated the same revenue of 1 crore rupees, but their profits might be differ. For example, if the profit A has a profit of 50 lakhs and profit company B might have a profit of 30 lakhs. So this is because the operating expenses and other expenses of the company B is high. So what the expenses usually occur is paying the salaries to employees, electric bills, current bills, and other kind of stuffs. So these expenses, as the company reduces these expenses, the profits must be higher, will be higher. So this measures, these margin ratios measures how well the company cuts this cost and increase those profits. That is why it gives, I gave you the definition as turning sales into profits. So reducing the expenses to making the profits higher. So this margin ratio gives you a clarification how effectively the company does this. So there are many types such as gross profit, operating profit, profit before tax, which is also known as earnings before interest and tax, or earnings before tax, and then profit after tax, that is net profit margin. So these are the margin ratios. And then comes the return ratios. These are used to determine how well the company generates return for its shareholders. What is return for the shareholders? So return for the shareholders means how well the company uses our investment. We have invested in the company. How well the company uses those money. So both debt or equity financing. So how well the company uses those capital, and how well the company generates profit, and from that profit the company returns for its shareholders. It gives dividends and all the other stuff. So this is what the return ratio gives, tells us. So there are many types of return ratios, such as return on equity or return on net worth, and return on capital employed, return on assets. There are then finally comes the market value ratios. So this determine how appropriately the shares of the company are valued and what type of return an investor might get. It can determine whether the company share is undervalued or overvalued or fairly valued. Suppose if you are buying the company stocks, you don't know whether it's a fair, I'm giving it a fair price for this company stocks or not. So with these ratios, you can determine whether the share is undervalued or overvalued, or you are buying at a fair price. So types are many. There are many types such as price to earnings ratio, which is popularly known as PE ratio, and price to earnings growth ratio, which is known as PEG ratio, and price to sales ratio, which is known as P by race or PS ratio, and price to book value ratio is also known as PB ratio, and price to cash flow ratio. So these are the various financial ratio analysis. This is one of the important fundamental analysis video. This is useful for positional traders and long-term investors or monthly traders. So if you are holding the stock on a monthly basis, these are important. For near-term and short-term traders, this video, this fundamental analysis is not important. This belongs to the quantitative analysis category of the fundamental analysis. So hope you guys would have got a clear clarification of what is ratio analysis, what are the various ratios. So if you like this video, give a thumbs up and share it with your friends and family, and also subscribe to my channel. It takes a lot of effort for these videos to make, and if there are more subscribers coming on day-to-day basis, I might get motivated. I will get motivated to create more videos for you guys. And also press the bell icon and press the all button so you get notified for all my upcoming educational videos. And if you want to join my trading course personally, I'm teaching trading, you can call my number on the scrolling below and you can get the details. I will give you the details. It will be worth the money. So and also if you want to open a demat account, I have given you Zerodha link on the video description below. You can start trading today onwards. You can open a demat account online. Only PAN card and Aadhaar card is needed. It's easier to open the account and you can start trading from now onwards. So hope you guys enjoyed this video. I will visit you on my next video, and until then, bye bye, take care.